Hey everyone, QIT here. In this video, I'm going to be talking about home bias, whether I'm concerned about how biased XEQT is towards Canada, and how to think about home bias in general. Now, in my previous video, I talked about the market portfolio and how it's a great starting point for all investors. So because Canada represents 3.4% of the global market cap, starting with 3.4% in Canadian stocks is a good starting point. And it's interesting to find out if deviations from that, small or large, make a big difference. I do want to take this chance to talk about what I've seen happen on Blossom a lot, which is people, after they've realized that mutual funds are real expensive compared to low-cost ETFs, they then try their best to cut costs at every corner. And sometimes you don't need to do that, and often the trade-off is worth the extra cost. I'm gonna just run through a few examples I can think of off the top of my head. So for someone that really wants to touch their brokerage account as little as possible, a robo-advisor might be a viable option. It's a good trade-off. You're paying a bit extra in MER, in management fees, in exchange for a lot of simplicity. And I can see this being the solution for a specific amount of people. Another example is XEQT related. XEQT has many ETFs within it, one of them being XIC that invests in the Canadian stock market. And of course, if you invest in Canada, it's going to cost a lot less. It's going to be pretty cheap. If you scroll down here, you see 0.06 MER. If you go to XEC, which is what they use for emerging markets, investing internationally, you can see the cost is 0.27%. So someone who wants to minimize costs as low as possible would only invest in Canadian ETFs. But no, we know we need to be diversified. So even if we're paying more for international, it is worth the trade-off. All this to say that some costs are worth the trade-off. And you don't need to bend your entire strategy and portfolio to have zero withholding tax. It's okay to have some as long as the trade-off is worth it. And I think a bigger deal is made out of withholding tax than it should be, to be honest. So let's get back to the main topic of this video, which is home bias. What's cool is Vanguard came out with an article last month on this topic, but important to note that whether it's Vanguard, BlackRock, or a bank with all these articles, it's important to not take them as gospel, because at the end of the day, these banks, these brokerages, they want your money. They want you to invest in ETFs or stocks or do trades on their platform so that they can get those fees. So always be careful when you read or go through these articles. But this one's pretty cool. It shows that in Canadian portfolios, if you're among the people that they analyze, they have 52.2% in Canadian stocks. And again, we talked about how 3.4% is the actual value of the Canada's weight in the global equity market, which means we are overweight 48.8%. If I just take a look at random portfolios on Blossom, here's one. Shout out to you, Dave. 66.4% in Enbridge. That's well above average. And then let's look at another one, typical portfolio. Enbridge, again, very popular, along with an H&R REIT, which is a Canadian REIT with a Canadian company. So there's more down here possibly. But if you just add the first, the third, and fourth entry, that's well over 50% as well. So why are people biased towards Enbridge and Canadian stocks? In my last video, I mentioned how this makes a lot of sense to me because people are going to buy what they know. They're going to buy what they consume or enjoy consuming, because that will influence them to think that these companies are great long-term or great long-term investments. But of course, in my previous videos and in older ones, I even talked about how this doesn't really make sense, because something that you enjoy using, and let's say generally the public also enjoys using, why does that make you think that that stock might be underpriced for you to get insane returns? Doesn't really make sense. But that's its own topic, so I don't want to deviate too much here. Another cool thing from the Vanguard paper is that it shows that it's not just a Canadian thing, that in general, people are going to overweight their own country. And again, that makes complete sense to me. We've got Canada, again, with a big difference at 52.2 to 3.4. United States, overweight. Australia, way overweight. Japan, way overweight. United Kingdom, way overweight. And the Euro area, way overweight. So now that we know home bias exists everywhere, and we talked a bit about why that's the case, let's get into why it might be bad. Specific to Canada, Vanguard, in the next few pages of the same paper, goes into security concentration and sector concentration. Those are the two main reasons why Canadians are more affected by home bias. Because, as you can see in this table, first table, the top 10 holdings, and these are names that you can recognize, RBC, TD, Enbridge, as we talked about, Shopify, Canadian Pacific, and then there's a bunch of banks, make up 37% of the Canadian equity market, which means that if you hold a lot of the Canadian index, your fortunes are tied to just a few companies. And if we move to the sector concentration risk, we both know, and we can see it from the top 10 companies, that Canada has a lot of energy stocks and financial stocks. We're really known for our banks. And again, if we have too much in the Canadian stock market and financial or the energy sector gets impacted, then we have a lot of sector risk. Our portfolio might do very poorly in times when those sectors are also performing very poorly, and we want to diversify away from that. Now that we've established why home bias might be bad, it's hard to tell how much home bias is bad. Is it 50%, 80%, 100%? How much home bias, how much contribution can you give to the Canadian market so that it's okay? So we know XEQT, for example, assigns roughly 25%, here 23.85, but roughly 25% to the Canadian market, and VEQT assigns roughly 30%, 29.81% to the Canadian market. So those are both way bigger than the 3.4%. But why? So I was doing a lot of research, even read through a lot of Reddit threads, and you might be surprised that Reddit is a good source of information, but the Personal Finance Canada subreddit is very good. They delete any comment that self-promotes, and they delete any scam type of posts. The moderators really do their job, and they actually push low-cost investing. So definitely a subreddit to check out. But here, one of the reasons when someone was asking home bias and how it might be too much, this guy who gets upvoted a lot, and he repeats the same mantra in a lot of threads, that BlackRock and Vanguard are the two largest asset managers in the world. They understand portfolio construction better than you. What is it you think they've overlooked? Meaning 25% and 30% home bias is correct. And like I mentioned before, Vanguard and BlackRock, they depend on us to invest in their ETFs to make money. So I'm not sure that they're necessarily doing their target allocation so that it's like the perfect thing. Of course, they still have to perform well. They want customers to see that their ETFs are doing good. But I think there's more to it than that. And when I listened, I did a lot of research. I listened to even old podcasts like this one by Canadian Couch Potato with Todd Schlanger from Vanguard Canada. And on Rational Reminder, I actually got someone from BlackRock as well. And they did talk about that they slant their ETFs to possibly contain more Canadian stocks than they would deem optimal for investor preferences, because Canadians probably want to invest or have a good amount in Canadian companies and to feel more comfortable. And therefore, they do talk about this, that investor preference is a factor of the whole equation. So this whole Reddit reply saying like they know better than you, so it's way better than 3.4%, and that 25 to 30% is optimal, not quite the case. And even I think specifically the Vanguard guy on the podcast, he mentioned that maybe in the future they might lower that Canadian stock allocation from 30 to 25. He could see it going a bit lower. So the number one reason why a Canadian allocation around 25 to 30% is okay was presented by Justin Bender on his excellent blog, Canadian Portfolio Manager. He analyzed a 80% stock, 20% bond asset allocation from 1980 to 2019 and decided to check out the volatility depending on the percentage that you would assign Canadian versus non-Canadian stocks. And what he would find would be if you were overweight to the Canadian equity market more than 0%, so from a 20 to 30%, you would have lower volatility. And I was just trying to understand that for the longest time, because like, how does that even make sense even from an intuitive standpoint? So Justin Bender is not the only one to have shown this type of relationship. Vanguard themselves had a paper in 2017, I believe, that showed these 4 graphs, United States, Canada, Australia, and United Kingdoms. But let's look at the Canadian one specifically. This axis is change in portfolio volatility, and the one below, percentage of equity allocations to non-Canadian stocks. So at some point, the more foreign stocks you add, you were going to have a reduction of portfolio volatility, but then it sort of reverses back. And why? So after much research and reading a lot of things in different theories, I've come up with my theory that this volatility reduction that you see is due to the fact that Canada is really specialized in the sectors that it's famous for, like financials and energy. So to give it only a small percentage of your portfolio devoted to it, you might not be exposed enough to those sectors. So you might not have enough financial or energy because Canada is known for it and the rest of the world is not. Now, reduction of volatility might not be your goal, but if it is, you want a portfolio of, I wouldn't say uncorrelated assets, because you can't really, everything in the market is correlated to some extent, but you want stuff that is not perfectly correlated with each other, and they all have to sort of have some amount of weight to be able to reduce the overall volatility. Because at some point, the more foreign stocks that you add, those foreign stocks might already be moving in the same direction of some of the foreign stocks you already have in your portfolio. So adding new ones don't really do anything. And that's why we see these relationships in this graph, where at some point it loses its benefit for reducing volatility. Now, if we look at the Vanguard paper once again, it says, looking at the data, the optimal asset allocation for Canadian investors is a 30% allocation to Canadian equities and a 70% allocation to international equities, because it's shown to minimize the long-term volatility of their portfolio. So I guess that's why VEQT has 30%, if Vanguard thinks it's the best. But that's just Vanguard saying that, saying it's optimal. It might be just pumping its own tires. It might be a marketing pitch. I don't know. But there are reasons that does make sense to me why we should go beyond 3.4%. Even though they're kind of minor, I think they add up together. So we know it's less expensive to invest domestically than it is to invest in foreign stocks. We also know that dividends are taxed very efficiently when it comes from Canadian companies versus US and foreign stocks. But I think Dan_O brought up this point on Blossom. These costs, these things just seem minor, considering the fact that XEQT and VEQT don't pay a huge dividend anyways. And I kind of agree. I think it's really all these little things added that makes you want to go maybe a bit more above the 3.4%. Of course, some people talk about currency risk. What if you have your portfolio is actually market cap weighted? You have 3.4% Canadian stocks and the rest in foreign and US currency or equities. Then what if the rest of the world does really poorly? Well, you're gonna be spending in Canadian dollars in your retirement. So having that currency risk near your retirement seems really risky, actually. But that's not really a strong argument, as Justin Bender would point out on his page as well, saying like, well, you could just hedge. You can still have exposure to these non-Canadian stocks, but just hedge it to Canadian currency if you're scared that the Canadian currency is going to do a lot better than the rest of the world. Speaking of Justin Bender, I've been referencing this page a lot throughout this video, and in the comment section, he does say, from a Canadian investor perspective, I will argue that a 50%, 97% foreign equity allocation would make more sense for the reasons outlined above. So that being stuff like volatility, costs, taxes, and other things that he mentions, that you should definitely check out that page. So he doesn't care if your market cap weight, you can have 3.4% in Canadian stocks all the way up to 50%. That's how he sees it. And for me as well, I haven't really read or run into anything that like convinces me that you have to have a very specific number for that home bias. So I would agree. It does feel like that 20 to 30% seems pretty good. Before we end the video, I did want to mention the last benefit that Justin Bender mentioned, called Behaviour benefits. Basically, if you only had 3.4% in Canadian stocks and they started to do really well, like 20, 25% return, are you going to buy a lot of Canadian stocks and get into the hype? And if that's you, that's why slanting it up more to begin with 25 to 30% might make you stick with that strategy long term, because Canadian stocks are constantly around us. We see how companies do, and like we just saw, people are heavily invested in Canadian companies because they use them, they enjoy them. That's why. So the allocation, whether it's 3% or to 50%, can depend on which percentage allows you or makes you stick to that strategy long term. And lastly, another last thing, in the original Fraser thread that I wanted to reply to, a lot of people are comparing VFV to XEQT, stuff like that, all in ones, and to US stocks. But they have to, one important thing you guys have to realize is, looking even at this table here, the US started to crush Canadian stocks starting from 2009, around that point, to 2018, and even beyond that. But the previous decade, which is like the lost decade, the famous lost decade, Canadian stocks did better than US stocks. And that's important to note, because when a lot of you are comparing VFV, let's say, you have to understand that VFV was, the inception date of that was 2012. So that's like way after the lost decade. So you got to keep your expectation within reason, knowing that the next decade, past performance does not indicate future returns. But if you're heavily influenced by the previous decade, you might think VFV is way better than any global diversified strategy. And I've seen that. I've seen, the standard deviation, the volatility, the return, lots of these things in people's comments. And all I'm saying is, like, be aware. It's like, I don't think VFV is necessarily going to outperform XEQT in the next 10 years. So be careful just looking too much in the past, because of when exactly these ETFs started to run. So with that, I'm exhausted, and I'll see you in the next one.